Welcome to What is the Market Going to Do? The biggest question. I'm going to answer it for you right now. But do me a favor, hit subscribe, like, and share. So we had this big breakout, but the party fizzled. Look at the volume. The volume the day before yesterday was below average. And yesterday, just at average. Where are the short covering? When you have these big breakouts, all the institutions and everybody who's short, they start taking and buying those positions back. And you always get a big follow through with big volume. It didn't happen. Now, maybe it was FedEx that scared everybody because they came out and said, hey, we're in trouble. We can't cut our overhead fast enough. The global economy is so bad, including the United States economy is so bad. We can't cut fast enough. If you look at their stock, you see how it's been tanking. Now, the other thing I noticed that we had a lot of bond holders dumping, and I also saw dividend stocks, people holding these dividend stocks, they're dumping. And if you look at the bond market, you can see clearly what's going on. You can see that we're in this downtrend. We've been in this downtrend. Look at the yields drop. And then look at the long market. If you go back and look at TLT, the long bond market, that's not doing well either. Look how it's going up. TLT is going up. That means yields are coming down. Why is that a problem? Well, it's a problem because if you take your 10-year and 2-year, you always want to make sure you're making more money on your 10-year than your 2-year, right? But what they'll do, if these yields keep on going down at a faster clip, what will happen is all of a sudden you'll be making, when they start trying to raise money, they'll offer more money on the 2-year than a 10-year. And that's an inversion in the yield curve. What are you, nuts? That kills the market. So there's all these things that are going on, all this noise. So what do? We put the noise aside, and what do we follow? We follow the money. We follow the pricing. So let's do that right now. So what I also saw is the mags are not really participating in this new all-time high. A few are, like our NVIDIA. We're doing terrific with NVIDIA. You can see it right here. Our NVIDIA is up over 40%. And then also our Meta, that's participating. And that's the same thing. That's up around 38%. And our Microsoft, we're not participating in it because it's got this gap, but it's doing well. But wait a minute, Apple, Amazon, Google, Tesla, what are you, nuts? They're not doing anything. Now, a couple of the AI stocks are doing good, like our GEV and VST. Those are doing well. We're up about, I don't know, 30, 40% in those. So my point is we're not getting a lot of participation. We're not getting a lot of volume. We're not getting a lot of participation. It's very narrow, the stocks that are participating. Now, another thing that was interesting is if you take the discretionary, stocks, the staples rather, and they're ready to break out, but right now they're not, and the staples they're starting to look like they're going to tank, and they're just right on top of that moving average, so they're not doing well at all. Our gold stocks are pulling back, and we've been in gold for a very long time. We got in gold back here in January, doing really well. Our GLD and our GDX, GLD, of course, the ETF follows the gold price. GDX are the miners. We did fantastic with those since January. But what you're seeing now is there's a consolidation going on right here, But that's fine. That's fine as long as. 4 minutes. So I'm happy with the consolidation, because we still have higher lows here. But if gold starts going down, if everybody starts jumping into this market, we get short covering, then gold will go down, and then we'll switch to a short position on our gold stocks, Silver is trying to catch up. It's consolidating here. It has a little gap, but I don't like silver. I stay with my gold. And the Bitcoin, I very seldom trade the Bitcoin, but I like about this is it's got what we call a flag pattern, and that's very, very positive. So what's going on overall is this. There's too much noise out there in the market. There's not a lot of confidence. There's not consumer confidence. There's not investor confidence. And also remember this. What drove this entire stock market from 2008 to where we are today okay, is 5.5 trillion in stock buybacks. Money supply, they increased it 173% from 2008 to where we are today. 173%. What are you, nuts? That's from 8 trillion to 21 trillion. So it's been driving this whole market from 2008 to 2025 and bringing us through the 2008 crash, bringing us through the COVID crash, is all the stock buybacks and all the increased money supply. That's what's been driving the market, not earnings, not increased productivity. But I don't care, because what I'm going to do, and all my members do, is we keep following the money, the price. And you can do that with us too. Join my gang, philsgang.com, free for 10 days.